Hi, happy Diwali. I'm Amit Premchandani and I'm here to talk about UTI banking and financial services fund. Banking and financial services have strong linkage to the macroeconomic environment and it accounts for a large share of GDP. A large part of it is in the organized space and it is listed. Most of the financial services are domestic in nature and essentially capture the strong underlying momentum of the domestic economy. Hence, this makes it one of the few large pure play on the domestic story. Traditionally, in the listed space, this sector largely comprised of banks and NBFCs. Though gradually, over the last few years, we have seen listing of non-lending institutions such as insurance, AMCs, and exchanges. And over the next few years, we expect the share of these non-lending institutions to go up as more of these companies get listed. As a share of broader indices, BFSI account for 30 to 35% over the cycle, and weights have steadily increased over the last few years. Going forward, as more non-lending institutions get listed, the weight is likely to be higher. As on September 2019, the fund has exposure across the financial services space, with split between banks and non-banks at 71-29% respectively. And among banks, the share of private banks have been 62%, and among non-banks, the share of housing finance and NBFCs have been 21%. We have broadly positioned the portfolio on the basis of following theme: market share. We believe that the sector is going through a significant market share shifts, with private banks gaining market share from public sector banks. On an incremental basis, private banks already have more than 50% market share. And this market share gain has come on the back of improving margin as compared to the last cycle. Hence, we have high growth private sector bank as a large overweight. Retail. Credit growth in India has been muted for the last 5 years, except retail credit, which has seen actual acceleration in the last 5 years, with share of retail going up from 19% 5 years back to 26% now. This is on the back of consumption being the key driver of the underlying growth in the economy. While corporate credit has seen a deceleration given lack of capex opportunity, most of the banks in the portfolio have strong retail lending franchise. Credit cost. Credit costs have been elevated with banks with large corporate sector lending exposure. Of late, flow of NPLs have gone down in most of the corporate lending banks. We expect the credit cost to continue to trend down and coverage to move up. Hence, we have large overweight in this theme. Uh, However, this theme is largely played through private sector banks with strong capital position and a very strong liability franchise. Another theme across the portfolio is to participate in the structural trend of rising share of financial savings as compared to the physical savings. Hence, we have almost 8% exposure to AMC, insurance, and financial intermediaries. These are very high ROE business. They have very strong growth runway. However, regulatory intervention is a key risk in the sector. We have taken a contra call on housing finance as valuation are at decade lows, long-term growth prospects remain intact, and monetary policy is accommodative. We have 21% exposure to NBFCs and housing finance, and of that, 15% is to housing finance companies. In summary, we believe BFSI as a theme has long runway for growth, with competition in the sector reducing, margin profile stable, and variety of liquid investable high quality names. An investor could allocate small part of his portfolio or small part of his saving to this theme. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.